Welcome to the Perspectives on IBC series, where advisor Chris Tormey joins me in a discussion on all things related to the infinite banking concept. In this educational series, you'll learn the basics of IBC and how you can recapture the financing function in your life so you can gain more control and freedom of your wealth. So welcome Chris. We're back for part 2 of the infinite banking concept series here, where we're sharing all aspects around how it works and how it could actually benefit you in your life around trying to take over the banking function in your life. And so we spent a lot of time in part 1 to just describe what is IBC, what is the infinite banking concept, this concept of having a privatized banking function where you can control it through the use of a permanent cash value life insurance policy as primarily the platform, right? It's not just about whole life insurance and the types of policies and companies we use, but how you use it strategically. And so in this part, we're going to go into how it actually functions. And so we can't go too far into it without just going through life insurance, right? Because there's a lot of misunderstandings of what life insurance is. If you Google it enough, you'll get a whole host of things, good and bad. Unfortunately, there's a lot of things that maybe point to it says it's bad. It's the worst investment if you listen to a lot of the talking heads out there. But this is just to help give you an idea of what it is. And so let's start with the basics, Chris, because life insurance is the whole life insurance policy. Permanent policy is the sort of the chassis of this strategy. And so can you share more about the different varieties of whole life versus term, et cetera, just to give people a perspective of what we're talking about here?
Sure. Thanks, Tom. Absolutely. So term life insurance, and we'll contrast that with whole life and other forms of permanent life. Term life insurance is insurance that's going to last for a term period. Thus the reason it's named that. And that term period is for fixed premiums. So just a simple illustration, $1 million policy for a 40-year-old person, $1,000 a year for 20 years. So if you think about that $1,000 covering $1 million of death benefit, it looks like that's about a 1 in 1,000 chance that you pass away that year. So you got to be a fairly healthy 40-year-old in order for that to occur. And most of the $1,000 you're putting into your term policy goes to some unfortunate widow or loved ones of a policyholder in your pool, which is that 40-something male or female and some degree of health. And the less healthy you are, the more that number will be for $1 million policy. It could be $5,000 a year because there's going to be more than 1 in 1,000 people who pass away. And people buy term life insurance mainly for replacing income that's lost due to a death. So if someone makes $50,000 a year, $1 million policy can come in to the widow or widower's life and be managed as an account, and let's say can last 40 years at $50,000 a year, which is $2 million. So the $1 million benefit happening the day after someone passes can, through proper money management, possibly last 40 years at 5% per year, but there's no guarantees on that. So very, very careful how that $1 million is managed, just like all the other money that happens to still be in that person's estate when they pass away. Those also have to now be stretched out to provide cash flow for the loved ones remaining, for lifestyle, for college, for whatever it may be. So term life insurance is a fantastic structure for replacing income when a family has income but doesn't yet have the assets built up, whether they choose to or not, to self-insure or fund a death through existing assets as opposed to contracting with an insurance company to buy it. Very, very different structure from a whole life or permanent life policy. For the moment, I'd just like to put permanent life off to the side. That's variable universal life, guaranteed universal life, index universal life is people talk about an awful lot now out on YouTube and podcasts. And just focus on whole life, which is really the area that you and I think, both practice most in. But we can visit the other forms of quote unquote permanent insurance. But whole life, I truly believe, is a permanent contract, and you pay much more than that $1,000 per million because you're not contributing solely to some tragic, catastrophic death that occurs that year. You're now contributing to your loved ones at some time in the future who are going to lose you. And they might be your wife, or your husband, they might be your kids, they might be your grandkids, might even be your great-grandchildren. But your contribution into that whole life policy has to be much larger than that income replacement for 10 or 20 years, because now you're talking about legacy, you're talking about cash value growth, and you're talking about essentially funding your own policy over the years ahead. And I'd love you to talk a little bit about those two accounts that are immediately formed: the real account, which is cash value, and then the shadow account, which is death benefit, and how throughout your life you're going to be able to access the first most of the time, and the second, I was going to say only once, but it can be accessed in other circumstances, and we can talk about that too.
Yeah, absolutely. And the way I sometimes simplify this is the difference between renting and owning, right? You rent a property and you're paying into it, and there's no asset that you're paying into, essentially. And so it's typically a cheaper route, right? So if you're owning a home, right, you're paying into it and contributing and building up equity in that same asset, an asset you own. This is in my mind, the distinction between term insurance and a permanent policy, like a whole life insurance policy, that you're paying into an asset that you basically own. And so the build up kind of equates to building up equity in the asset that you just purchased. And someday you will leave this earth, as far as I'm aware, and that asset, that death benefit, I like to affectionately call a lifetime payout, because it's all the income that we're going to, the value we have as humans, we're going to bring to this earth. Like, that's the payout at the end. We just get to use some of the cash along the way as it builds up in the form of equity in the policy. So that's how I usually try to describe it, because that's what you're building towards. And so that's why it is more expensive, because some portions of that of the dollars you are contributing to this asset pays obviously for the death benefit, right? That hopefully you don't use early, but you might. But it's giving you access to cash that you can leverage for different reasons by borrowing against the asset and from the life insurance company directly. And so that's how I kind of describe it.
Absolutely. I'd say the difference that's got to be, made sure we see is that, unlike renting versus owning, where the cost per month is going to be, somewhat similar, with whole life, you are contributing a lot more. So that first 1,000 still goes to some unfortunate catastrophic situation that someone died that year, but perhaps another 9,000 in addition to the one, well, that's going to an account that the insurance company manages. And for this reason, we like mutual insurance companies who are managing that account for their policyholders, not for a combination of dividend holders, a publicly traded company, and policyholders, but exclusively for those policyholders, almost like a contribution to a retirement account or a contribution to college savings account, something that they know is earmarked for them later on down the road, and even unlike a college savings account, unlike a 401k or IRA, is actually earmarked for using it even this year or next year. You don't have to wait that much further. But it is an ownership, and it's an ownership in your legacy. It's just that you're going to have to contribute more because you know that money is coming back to you, both in the near term, if you should desire it, and in the later term, should your family need it.
Right. And that's why we don't talk about it in the way of one or the other. There's definitely reason to have both, especially given people's, especially if they're starting off, right, with their lives and their families, right? Having both can be very powerful, and there is some synergy by having both, because you can use some of the term policy if you get the convertible kind to create those permanent policies down the line, yes, as cash flow allows. So there's a good play to have both. But, the reality is that a lot of term insurance policies, people in a good way outlive them. Right. It's just the way it happens. And so the vast majority of people will never get a direct benefit through a death benefit, but it is still good to have the protection in place in the case of something bad happening as people are growing in age. So, but to that point, term insurance, no cash value buildup, right? It's just a more protection-based product. But like as you're describing, whole life insurance has this cash surrender value, right? So that's the equity in these policies, just like equity in your home, you're building up. And so the risk as you build up this equity in these policies, the risk to the life insurance company shrinks, right? Because you're building up cash into it. And so it's important to recognize for what it is. And, there's this thing that goes around, you hear from some of the experts out here. Well, these darn life insurance companies, they when I die, they get to keep my cash and they only pay out the death benefit. I mean, what do you think about that?
Yeah, I've heard that too. So the way I look at the cash value and the way I explain it to people that I'm working with is that is the price today that the insurance company will pay you to tear up the contract. So it's basically, they have risk on you. If you pass away, as tragic as that is for your family, your neighborhood, you yourself, now that you're gone, the insurance company has to step up and pay out $1 million. So if they know it's a permanent policy, they... especially if you've gotten, older and iller, sicker, since you signed up with them, since you opened the policy, they'd love to pay you that cash value if you want it to leave. Now, if that cash value is less than the amount that you've put into the policy, you take it and there's no ramification except you no longer have any protection. You no longer have that death benefit. If that cash value is more than what you've put in, there could be some tax ramifications to you. So something to be very aware of if your policy is longer than 5 or 10 years old. But if you have gotten ill, if you are sick, the insurance company bid price for your life insurance may not be the best price to pay. And there is a whole market out there among people who will actually sell their policy to a third party for much more than the cash value. But that's a whole separate conversation we could maybe get into another day. But the cash value is essentially the probability of them paying out the $1 million if they are to measure that probability with your health at the time when you originally bought the policy. Not better, not worse, the same, because they don't know what's happened with your health since. There's no requirement to report anything around health. And then the second thing is your age, which they do know. They know what your age was when you started, and they know what your age is at any moment in time because it's in the system. So that is the probability that you're going to pass away that year. So if it's $30,000 on a $1 million policy, there's a 3% chance that you could pass away that year. Or at least that's what the insurance company would pay you if you're alive and well. If you die the next day, Well, the probability that you're going to die is now 100%. So the 30,000, which was the 3% chance you were going to die, disappears, and $1 million goes to your heirs to the extent that $1 million is the death benefit at that moment in time. We'll get into this, but death benefit as well as cash value can grow over time. So a term policy stays fixed at $1 million the whole 20 years. A whole life policy can increase the death benefit as well as the cash value over time. So that's the way I explain it to people. The cash value is there for when you're alive. The death benefit is there for when you've died. You don't get both because you can't be alive and dead at the same time.
Right. No, that makes sense. And that's, same with a house, right? If you're borrowing money to buy a home and you're building up equity into it, and say you fully paid off this home over the course of 30-year mortgage, I mean, the bank's not going to give you the keys to the house and the equity that you build up. They're just going to value the home, right? So it's the same concept. You can't have both, right? In that scenario, it doesn't make any sense.
No.
And that's kind of how these permanent policies function very similarly. So, and the good thing about it is whole life insurance, the type of permanent policy we certainly Nelson Nash and we sort of support for an infinite banking concept can be designed in a whole host of ways, right? And there's different ones that have different durations to them. Some to age 65, could be 10 payments, right? There's a lot of flexibility into them, and this is where knowing your situations and your would be very key in working with someone who can adapt to your circumstances to design something really suited for you is really going to be key. But we do push to use mutual insurance companies because, one, that we as insured members of this organization, we not only get guarantees in the contract of what the cash will be, but we're eligible for dividends from the profitability of the company. And those come back to us and we get the benefit from them. And they're not guaranteed. That's the non-guaranteed portion of it. But these companies that we're using have been around for well over 100 years, been paying dividends that long. So the expectation is we will see them. But so that's why we choose these types of companies. And we'll definitely go into that a little bit more in this series.
Yes, absolutely. So, and one thing that came to mind is when a dividend is declared and you are paid that dividend, and the amount you get as a percent of what's declared depends on your age, how long the policy is that you've had, your health, because there's different pools, and those pools are based on probabilities of dying. So the less healthy, the older you are, you get less of a percent of that dividend than the top health, youngest people. That's why we encourage people to start early. But once that dividend is paid, that cash, if it stays inside the policy, which we encourage people to have their dividends stay inside their policy while they're growing their wealth, that dividend is now part of the guarantee. So the guarantee that starts at day zero, as new dividends get added to your policy, those dividends, even though the dividend itself wasn't guaranteed each year, although as you say, most mutual companies have never, not in a single year, paid a dividend. But if a dividend is paid, it then becomes part of the overall guarantee on the cash value and the cash value growth. So really, really a powerful thing. But worth talking about now, and I'll toss the ball back to you. Why can't you just drop a whole giant amount of money into a policy to get it growing and going? Who's there to say, wait a minute, there's some limits, and why?
Right. And this kind of goes back to the 80s and some of the law changes that were enacted. And it's our friends at the IRS who will limit this, right? Because there are certainly some tax benefits with this type of financial tool. And so there is a limitation to ensure that it remains a life insurance policy. And so there's rules around this. It's called the MEC, and we're definitely going to be going into this in the later parts of this series. But what's a modified endowment contract, and And so that limits, it puts a ceiling on how much we can contribute to these policies. So this is where the design of the policies are really key, to allow for the maximum amount to, so you can contribute based on what you're trying to achieve here. So we just have to always factor those in, but the IRS is the one that's really limiting it. Just because of a lot of the tax benefits of it. So we just need to be mindful of that for sure as we're designing them and how we use them. And so this is where it goes into, maybe this is a nice segue into, obviously we're building up cash. It's great. We're protecting ourselves from our families and others, in the potential, premature death. But this is where the IBC sort of world really really takes hold, is being able to leverage the loan provision that is within the whole life insurance contract for use now, right? We don't have to withdraw the cash, right? That's building up. We get to borrow against it. And it's written in the contract that we have first rights to use those dollars, and we're not using our money. And maybe we can talk more about this, Chris. We're using the life insurance company's money, and we're using our cash value that we built up as collateral. And so why would a life insurance company allow this to happen?
Yes, they would allow this to happen because they are seeking assets that provide them a yield so that they can pay beneficiaries, pay themselves as an institution, and pay dividends. So if you use your policy, as you're allowed to by contract with the insurance company, to collateralize a loan with the insurance company, you've now got two separate relationships at the same time with that insurance company. One is the one you had already, which is as policy owner, which gives you death benefit, cash value, and growth in cash value based on dividends, and also based on just the natural movement of cash value higher over time, the guarantee. When you decide to access cash that you've built up, it's really the collateral, or let's say I used 30,000 before. Let's say you've got 30,000 in cash value. You can go to the insurance company and request to borrow up to 95% of that 30,000. So in that case, $28,500 from the insurance company itself. Now, the insurance company itself will have to find cash, not from your policy, but from their own general account portfolio to pay you on day zero, $28,500. But then an asset is now on their books that is paying them, let's say, a 5% rate. So 5% times $28,500 is a couple of $100 a year that you are going to owe above the $28,500 that you took out in order to give their portfolio a positive return, which is what we all want as policyholders. So those who choose to pull the money, they become a debtor to the insurance company itself. And there's absolutely no testing or parameters that the borrower needs to go through by contract, because they don't really need to know what you make for your income. They don't need to know what other assets you have. They don't need to know what credit card debt you might have, etc. All they need to know is that you've got cash value with them and a death benefit overlying that cash value. That is enough, and it's in the contract written. That is enough for them to immediately provide you, when I say immediately, let's say a week, to provide you that cash to use for as long as you'd like, for whatever reason you have to use it, and anytime you need it.
Yeah, and the beauty, right, to your point, like, and you are paying interest while your current cash value in your scenario, 30,000, is still working.
Yes.
Right, because you haven't actually withdrawn anything. Like, you think about it in your own savings account, if you need to use your cash, you would have to withdraw it, right? In most cases, that's what a lot of folks do, and there's nothing wrong with that. But now that asset's slowing down in terms of how it can earn, right?
Yes.
Because that amount is actually withdrawn. Here, you're not withdrawing it.
No.
You're keeping it whole. You're borrowing from the life insurance, and then you are paying it in an interest rate, right, to the life insurance company while your money continues to earn and grow.
Yes.
Undisturbed.
So that 5% you pay, that disappears into the insurance company and basically is part of that dividend announcement at the end of the year. The other $28,500 in my example that you need to pay back, you can pay back $100 anytime or $1,000 or the entire amount. It's entirely up to you. Now, when the next premium payment is due, that has to be paid because there's only $1,500 left in the cash value. There's no cash value sitting there to cover the next premium like there would be if you so chose had you not borrowed the money. But worth saying something about withdrawals. The modified endowment contract that it would become if you put too much cash value into a specific death benefit changes the nature of withdrawal. So you can withdraw as well. And some of our older clients will choose to withdraw because they're not taking that money for an opportunity or an emergency that's short-lived. They're taking that money almost as an annuity payment. When an insurance policy is set up that is not a modified endowment contract, if you put $100 in and it's now worth $200 because of dividend growth, you can take $100 out without any tax ramification. The other 100, which was your gains, stays in the policy. If you put $100 into almost any other asset and it doubled to 200 and you wanted to take 100 out, you would take 50 of what you put in, and the other 50 is your gain that you will pay taxes on that year. So that's what's so valuable and interesting in our minds about insurance policies, that you do have that option to either borrow from the insurance company using your policy as collateral or withdraw directly. And we do recommend this to our clients who are in their older age and not generating income out of their jobs anymore. This is another place to draw tax-free income. Your basis, whatever you put in, comes back out without any tax ramification at all. And if it becomes a modified endowment contract and you put in 100, it's now worth 200 and you wanted 100 back, you would have to pay taxes on $50, just like you would with a stock or a bond or something like that. So those are the two ways to access your cash. And like you said, I totally agree. When you withdraw money, rather than take out a loan and use your policy as collateral, you're making your container smaller. You're making the potential of that policy not as large as it was prior to when you took the money out. So ultimately, you're contributing to your lifestyle and reducing the size of your legacy. Through a loan, you're temporarily accessing cash, hopefully not for lifestyle, but you're allowed if you want. And I have had clients who've had large credit card debt, and we get that fixed with a policy loan, and then we fix that through savings. So you can do that, but we really encourage using that loan for productive or emergency type situations.
Absolutely. And within, and Nelson Nash always sort of talks about being an honest banker. And certainly as you're building up your policies and potentially leveraging some loans from the life insurance company for whatever, right? You have that free game, whether investments or maybe paying for college, whatever the case is, that you pay back the loan, right, through the life insurance company, right, to be an honest banker. There might be a situation down the line later in life that you may not pay it all back because your death benefit will pay it off. But certainly as you're building up your IBC sort of environment and platform, being an honest banker is key, right? Because it's not like you just throw money in, you just take it out and never pay this back. Well, we have to stay disciplined with it. And really, certainly early on, it's key to make sure that you're doing that. Because think about it. And so this is where I'll segue a little bit. I mean, So what we talked about is fairly straightforward, and most people who at least own homes and have home equity lines of credit, it can work in a very similar fashion in that way by leveraging your equity, right? In this case, cash value to get a loan. And so, when Chris, when you're comparing this, right, between say a home equity line of credit and say taking a loan from the life insurance company, what do you see are the kind of main differences that come to mind?
Well, a home equity line of credit, they are going to check income. They are going to look at all your debts. And when I say they, the bank, because home equity line of credits are coming from the bank, they are going to be looking at your financial profile, both assets, liabilities, and income. And you could certainly be denied a home equity line of credit. And of course, the value of the home is a very important thing as well. Where it's the same or similar to life insurance borrowing is there is no tax deduction from your home equity line of credit anymore. There used to be. And there is no tax deduction from your life insurance loan either, because it's really being used for personal opportunities, for personal emergencies. So that's the big difference. Is a home equity line of credit is an application process. With a life insurance loan, all the application process or the underwriting of it happened when you bought the policy in the first place. There is a request for loan, but it's not an application that can be denied. It's basically just the paperwork to have everyone have a record that you received X thousand dollars on some day, subject to whatever the interest rate was. And that's the second one. The interest rate for the life insurance company is announced once per year, and your loan will be subject to that new announced interest rate that happens once per year. There are policies that do a fixed rate throughout life, but we tend to like the variable because that allows for that cash value dividend growth to move up as well. So fixed loans will sometimes harm the dividend if you have a loan outstanding. Floating loans tend not to. So once a year, the rate is announced. With a HELOC, every time the bank chooses to increase or decrease, but these days, this last year or so, it's been increased, the rate, your balance will be increased by that amount that day. Whereas with insurance, it's that once per year that you need to think about it vis-a-vis where else you could get money. So those are the two that come to mind for me. How about you?
Yeah, and I think the power of it is the terms, right? When you talk about loans, one, you have to apply. You mentioned that, but the payback schedule. This is where it comes to discipline too. Is with a home equity line of credit, there's going to be at least a minimum interest payment, right? They're going to require.
Yes.
From a loan from the life insurance company, that is not required. That is going to be giving you a little bit of flexibility when to pay that. And again, we say back to the honest banker sort of concept, you should pay it. But if something does happen, there's something unexpected, you can pause it. And it's under your control when you pay this back. And so that's really adds a tremendous amount of flexibility, especially if you're using some of these lines of credits from the life insurance company for business or investments and such, where there might be some need to build in some flexibility. So that's really great. And
Yes.
and you certainly can borrow more than you could from your life insurance policy in terms of percentage of your cash, your equity, than you can from your HELOC, because the banks want to hold up and protect themselves, right, in case market fluctuations occur around your home. They want a cushion. So here in the life insurance, you can, like you said, borrow up to 95% of your cash value and deploy that for any purpose you need. So those are things that really jump out to me.
There is a third I just thought of, and that is, let's say you get a $200,000 home equity line of credit and you pull 50. The bank can evaporate the other 150 line, and they can evaporate that and say they can't take your 50 back immediately, except under the terms of the contract, which usually, as you said, does turn from an interest only to an interest plus principal type loan at some point, usually a few years out. But for the amount that you've not yet drawn, the 150,000 you haven't yet drawn, opportunities tend to arise when crisis is occurring. You could see a home or some sort of, an investment property or some sort of other very attractive investment and want to draw that 150. Well, based on the value of your home, which may have changed lower, or based on the liquidity available to the bank itself, nothing to do with you, they have full rights to deny that extra 150. So the original underwriting for the 200 is subject to change on the undrawn amount. As far as I know, pretty much any time. So with the insurance company, again, you've got that 95% of the cash value, no questions asked. And that cash value will grow even while you have your loan outstanding.
Yeah, really powerful stuff. Tremendous place to store. Well, if it gives you some added flexibility to access loans from the life insurance company that you can control a bit more than through traditional ways in banking. So I think we covered quite a bit of ground here, Chris, centered on the how IBC truly works, the policy to loans. And so I think this is a good primer for that. And we're going to go into the next portions of this series to talk around why was it even called infinite banking?
Yeah.
Right? What is that? It sounds like a fun name, but why did Nelson Nash use that? And then go a little bit more into the life insurance industry and share more about that. Obviously in the time of recording this, there's a lot of noise around the banking industry. Well, what's the life insurance industry look like? How safe is that? So we'll go more into that in the next series, but this was great.
I've really enjoyed it, Tom. Thank you so very much. And as you can tell, we're both very excited about this infinite banking concept and your ability to really leverage your wealth and your savings if you're able to put your mind to it. And we're here to help for sure.
Great. See you on the next one.
Take care. See you soon. Bye-bye.
Thanks for listening to this podcast and hope you're enjoying this series on the infinite banking concept. Next up is part 3. How does a whole life policy work? In addition to the podcast, I would highly encourage you to get the book Becoming Your Own Banker by R. Nelson Nash. If you want to discuss how IBC can enhance your financial life, feel free to book a free call with our team. We'd be more than happy to help. Visit perennialpride.com to book your call.